Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
He's the one.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella's story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Capital Hacking begins in 3, 2, 1.
Welcome back to the big show. Josh McCown here, illustrious John Edwin, back in action.
Yeah, Josh, that was a great show with Matt Faircloth. His fourth time on, and I think it was the most fun and probably the most informative show that we've had with him. He really did an amazing deep dive and good teaching on all sorts of real estate spaces today.
He did, because, from the minute we've known him, he had, he'd be already started his path to be a best-selling author of How to Raise Private Capital by Matt Faircloth. So that was where he was, and how he does it is he looks at multiple asset classes, and today he's looking at hotels. So he's going to do a deep dive into his rationale, his arc, his story, and what he's finding in that world today. And he's going to do a deep dive into a new way to look at cap rates, capitalization rates. So if you're not sure what that means, great, you'll find out. Oh, by the way, John, do you think everyone listening right now has a second? Do they have 1 second to click the subscribe button, you think?
Absolutely, guys. Please like, subscribe, and share this podcast with your friends and family, because it is so informative. And make sure you also pick up Raising Private Capital by Matt Faircloth, best-selling book.
You'll love this episode. Matt Faircloth, it's fun to have you here, buddy. John and I were in the middle of chatting with you. I said, let's just hit record.
Here's your problem, Josh, is that me, you, and John are friends. And so you think this is going to be this fun interview. Well, Matt, tell us about your backstory and where you came from. It's going to be like the other podcasts and shit. No, sorry, Josh. This is going to be 3 guys talking. 3 dudes talking. And we said what we were doing before is I mentioned when we got on, hey, how's your morning been? And I said, I went to the gym. And Mr. Edwin, my personal trainer buddy over here, what did you do? And so if you'd like, I can continue with what I did at the gym.
Yeah, my favorite part was that you said, I'd rather show you guys in the camera what I did than tell you.
Well, I don't know the names of these things. I just know how they make me feel. And I have a pretty good guess on the muscle that they work out, and sometimes I observe others doing and I had a trainer for a while, but he didn't, he might have said the name of the machine, but I was not paying attention when he said it. And so I didn't remember. So I was just saying, I'm working legs today because we all should work legs, right, John? Why should you work legs? Why? Why can't I just do chest every day?
Legs are the pillar of the temple. And if you view your body as a temple, then it's the foundation. So you got to work your legs, especially as we get older, for men and women. Specifically, let's talk a little bit about women if we're going to get into it, because as women age, get into their 40s and 50s plus, their bone density is breaking down a little faster than males because we have testosterone, we have denser bones, and we can get into all that. But
osteoporosis and all that stuff, right?
Yep.
Yeah.
So
ain't nobody got time for that. So, I don't. That's not what I'm living. I'm
along for the ride.
So
awesome.
I did the sit thing, John. I did I've discussed the other ones, the squats that I called wrong, where you put the butt, where you sit down and you curl your legs in, and I did all that. Okay. Then I did the one that I only see women doing. I never see men doing this machine, right. But guess what, John? I'm not too proud. I did the machine too, where you sit and you scissor your legs in this way. And then
they called that the Thigh Master in the olden days, didn't they? What was that?
I think it was a Jane Fonda Thigh Master.
Thigh Master. Now they made a machine out of it.
Yeah, it's called an abduction machine if your knees are going apart, because they're going away from the midline of the body. So it's abduction. Yes. And if they're coming together for the inner thighs, it's called abduction. That's the abduction machine.
I feel like you said the same word twice.
One is ADD and one is ABD. So abduction and adduction.
What if I have ADHD?
Dude, that was awesome. I actually thought the same thing, man. I thought they were the same word.
Didn't sound good. I'll call that. I'm not proud. I'll call it out.
But he's so smart.
What do you call a machine that does both things? because this is that this machine does is there's like this
It's a
handy
setting,
little
right?
switch that
Yeah.
you do it in.
Yeah, you could probably lock
then-
it one direction and get resistance one way, and then
Is there a name for that machine that also sounds like those two words you just said, or no?
Well, it depends on the direction. So if your knees are going out, if that's where the concentric phase of it is, that's called abduction. If
I
concentric
feel like he needs a whiteboard, Josh.
phase is going towards the midline of your
Will there be a test at the end of this?
Are you guys as intimidated as I always am when I
so-
get to work with John Edwin?
So
I mean,
I
he's
did
just a
the sit
stud.
I did the sit at die master thing. Let's just kind of call it that. That's what me and Josh are calling it. I did that I only see women do, but I'm choosing to do because whenever I do it, it really I feel muscles that I don't,
Right.
use very often being used in my thighs and that. So I did that machine. Is that it, John?
Did you do lunges? Did you do any walking lunges? Because that's pretty important.
No, I didn't. I normally.
Is it really,
should.
John?
Yeah, that'll
should
hit
do
those
lunges.
muscles that you're not used to using that you feel specifically, like the adductors just outside of the hamstring muscles.
Okay.
Walking lunges.
I'm gonna switch
I
gears
don't,
only-
I don't like lunges, John.
I know.
Most
Okay,
people
here's the deal.
Nobody does.
Hold on.
Yes.
We got to get to the business because so many
Why?
people are excited to hear you. This is, but
It's
got to
4
be your
minutes
fourth
in,
time.
Josh. Let us chat a little
It's your
bit.
fourth time being on the show. It's 400 plus episodes today, so we try to get you on one
Really?
per century, and we've done a good job of that. And why do we try to get you on? Because I am a huge fan of you, your lovely wife, and the DeRosa Group. But not everyone has been here for all 4 of your shows, so you've got to tell us a little bit about who you are and a brief backstory.
You're acting like
Please.
I remember what I talked about on those shows, Josh.
You don't have to. Just who are you? That's all the audience wants to know. Who's this handsome
My
devil?
goal on this show, John, is to throw Josh off as often as I can because he's trying to keep you and I aligned here, and I'm going to just keep throwing snowballs at him as often as I can.
Like Buddy there.
Thank you, Josh. And listen, I'm not trying to be like, oh, hey, haven't you heard of me? I'm just a dude making it work, right? They got lucky to get to waltz into the door of Bigger Pockets many, many years ago, and I worked very, very hard through that organization to get the sunshine on me, and I'm grateful to have all the sunshine that I have. So that's me. But what I do is I'm a real estate investor. I get other people to join me on ventures for real estate projects. Could be multifamily properties, could be a fund that we have that lends money to other real estate investors to help them around second base and get them home again. That fund, God bless us, is sitting on $11.5 million of other people's money right now. And that fund has created 60 jobs. That
Wow.
fund has created 45 housing units. That fund has brought back 13 dilapidated buildings that used to be nothing and are now places where people work and live.
That's beautiful.
And so that's what that fund's up to. And it's also returned over 10% to our investors annualized.
That's great.
So, and it's also not a not-for-profit. I also do get paid when I do that as well. So it's a win-win. So that's that. And now our company's buying a couple of hotels. And really we're a place where people can put their money, watch it grow, know that there's a team that is feverishly in love with what they're doing that works for that company. And
really
the
nice.
company's dedicated to creating great lives for the residents that live in the properties that are being touched by it. And also now the guests that are being
I
touched
love
by those dollars too. So that's what we do.
Well said, man. That's a great intro. And also, you're doing guest hosting on, or are you hosting on the Best Ever show?
I am one of the hosts. They can come see me after you watch Capital Hacking. Listen to Capital Hacking and watch Capital Hacking.
Both.
Whatever you're doing. After you listen to this, go over to Best Ever on Fridays and listen to my
Awesome.
episodes of the Best Ever podcast that drop on Fridays. So
Matt,
just happened in the Best Everville, man. I need to get you two knuckleheads on the show.
we would love to, and congratulations on that too. I mean,
Thank you.
on so many ways. Look, you're a gentleman from the East Coast. You have this great track record. I mean, you've kind of moved through all the asset classes of real estate. It sounds like. I'm not sure you've done commercial and industrial, but it seems like you did the houses, the house
Not industrial
flipping.
is the one I haven't done. I've done an office building. I've done retail. I've done flipping. I've done like 1 or 2 wholesale deals, and then I realized, hey, I hate this, so let me not do that anymore. So I want to hold the asset. I don't want to make somebody else rich. I want to create value and monetize it through a sale or a lease. That's what I want to do.
Hey everybody, it's Robert Helms, host of the Real Estate Guys radio program. And when you're not listening to our show, make sure you're tuned to Capital Hacking. You're going to dig it.
And you've been a teacher forever, right? I mean, that's been your strategy from the beginning, is you've always shared what you're doing. From beginning at like local meetup RIAs back, 12 years ago, 13 years ago, maybe?
Yeah,
maybe 15.
Through SJ RIA. Yeah.
Right. 15 years ago. And things like that. Then you got to became very close friends with Brandon Turner and Josh Dorkin, and then of course, who's the gentleman who created Best Ever? Because you knew him at the very Joe
Fairless. I hired Joe as a mentor, and because I was in the middle of a 49 unit apartment building, and that's right when I joined GoBundance. I bought that 49 unit, and it's up for sale right now. We're about to sell it. And Joe coached me through the acquisition process on that. Joe also coached me on, what are you doing that's working in your life? I was like, well, I've been posting these videos on YouTube for these private lenders that are working with me. And I've been putting them up on my social media feeds and on YouTube. And it's starting to get comments. It's starting to get action. And I just am teaching different things. And he's like, how frequently are you doing that? And I'm like, whenever I do. I just do it whenever I feel like it. He's like, okay, get a regular cadence. Do it twice a week. See what happens. I did it for 6 months, twice a week. The subscribership exploded. That's when YouTube was a little bit easier to infiltrate, right? And so that's really where my teaching muscle.
Teacherhood?
Yeah.
Teacherhood?
That's it. I made it up.
I'm not. Yeah, you made that up. Your teachery. Your teachery.
My teacherification. How about that? Yeah, that's where my teacherification kicked in.
And then, by the way, we have
my joy of teaching others. How about that? That's
how
really
about this? How about this?
Before we move on, hold on 1 second. For those of you who are listening and don't know who Matt Faircloth is or don't know him personally, Josh and I have the joy to be to call him our friend for many years. And he is just a guy with a huge heart and truly cares about his tenants and the people who work for him and the families that invest. And, Matt, you and I have had many conversations about it. And this isn't just like an advertisement for you, but a lot of people are in real estate because there's an ends to a means. And, that's the vehicle for them to make money. But you truly care about it. And it is an honor to have you on, bro.
Thank you, brother. Thank you.
And
as
you're
you
the best
selling. Friends, and then I love throwing Josh off his game. What do you got, Josh?
Your best-selling book. We never talked about it. You're one of the most popular selling books in the world of real estate capital.
It's because of that book that I made.
That is the book. I read the book and called you. I called you and pursued you for my mentorship.
I know. And I'm like, well, I can't raise money for a resort. Are you kidding me? I don't know what that is.
Involved in, he was part of Renault Winery Resort.
And you were the OG, right, Matt?
Yeah, I was. And Josh was like, kind of like Josh is tenacious enough to not take no the first, second, third, fourth time, right? And that's in some ways is part of it. If there is a equation of success in life, certainly not taking no the first time is in that equation, right? It's probably success is probably true, like for different people, different ways. But I admired that with Josh, that he kept going when I told him no again, and again. And he stayed on me. And finally I was like, all right, fine. I'll come look at this place you're buying down in South Jersey. Okay. And I drove all the way down there and I'm like, holy crap, look at this place. Looks like crap, but I can see what he wants to do. Yeah, I can see what this man wants to do. And I said, okay, I'm in. And that. So that's how you and I met, is because of that book.
It is. And but anyway, and I think wait a second, were you the introduction to me for GoBundance? Oh my gosh, 100%. The full circle, John.
I'm your granddaddy.
Matt says to me, you should join GoBundance.
I get credits every year.
You probably should get credits.
You never knew?
You do.
I
Don't
do.
you get credits?
No. I don't should. I do, brother.
You do. I'm
your granddaddy.
I wanted to make sure.
I'm your GoBundance grandfather.
So that means that's how I got to know John.
GoBundance, give Matt Faircloth credit, not John Edwin, not Josh McCallan. Here, go.
I love that.
Okay, we're going to take one more digression. We'll come right back. But Matt and Josh, I don't think you guys know this, but at Tribal Council a little over a year ago, Matt King put up a thing on the board of like the top recruiting GoBundance members, and both Matt Faircloth and I were tied, I think, in 12. I mean, Brandon Turner and David Green were the top two by far because of bigger pockets. And then Tim Rode fell in there and Pat Hyben. But Matt, you and I as individuals both had brought on 15 members each. And so we were both tied there.
It's good organization. I talk about it regularly. It's changed my life. I mean, if you want to win in life, surround yourself by winners. The end.
Damn.
You know?
All right.
Mike.
Now, Matt, you are a great teacher. So over the years, you've done a great job with multifamily. You've I don't know how many doors you have today. How many doors you have in?
2,000.
2,000 doors. Not done by many people in this world. So thank you and congratulations.
It's about to be a lot less. We're selling a lot.
You're selling some?
Yeah, it's pricing. It's a good. It's believe it or not, it's actually a good time to sell. And it's a lot of it is asset classes that I don't believe are going to do well in the next 10 years. And so I think that it's a good time to pull profits and consolidate. And so we're going to be getting into different things. So.
Well, I wish you could teach us on cycles because it's different cycles, right? I mean, there's different times when money's cheap and, you know, you do different things at that time. You make different decisions.
You have to. You cannot change the market. All you can do is participate. No, you just participate. That's it. You either go against it, or you lean in and go against the wind. You know, I mean, like I could just spit in the wind all I want, you know, or I could build myself a kite and enjoy the wind. And
so what is going on? Let's pause there. What is going on in multifamily that makes it a good time to sell?
Okay. The majority of people that live in multifamily are people that it is their economic structure. And I'm judging. I'm not judging. Sorry. I'm saying this with love. I'm loving these people. This is where they're at. A lot of America, it's their economic structure to live in multifamily. It's what they can afford. They're likely not going to buy a house because of perhaps choices that they've made or because of their vocations or whatever it is, or because they don't want to deal with a house. They want to call somebody when they got a roof leak or call somebody when they have problems or whatever. So around 50-60% of America lives in some sort of a rental housing and wants to live in that rental housing forever, right? So those folks that live in rental housing, let's call it, of that subset of 50-60% of America that lives in rental housing, around 50-60% of those people are in some section living hand to mouth, meaning like they have less than 10 grand in a savings account. They earn at or below 60 grand a year. It's a lot of America. They are, right? The cost of housing for most rental housing in America, all rental housing in America, has gone up 25% in the last 7 or 8 years, right? And so because of that, it is squeezing all those that are renting. Now, some people are able to afford it. It's fine. It's a rounding error. A lot of folks are not. And so what that means is they're still getting it done, and there's not mass evictions, mass delinquencies yet. It's certainly increased. It's delinquencies are up about 10% in the country right now. And so what that means is that we are at the top of the ceiling. And unless we start increasing wages in the United States, increasing jobs, and maybe that's something that happens down the road, that's something our current administration wants to do, but they cannot poof magic wand, open up 7 Apple factories and, bring auto manufacturing back into America, bring steel manufacturing back and poof reopen up Bethlehem Steel. All those things will take time, right? And so because of that, we are at the ceiling on what the majority of America is going to earn anytime soon. And that means we're at the ceiling of what you can make in rental revenue. So backtrack to the last 10 years. What's made multifamily exciting is big multifamily operators and owners like myself, and dare I say John Edwin too, because I know that you've got a sizable portfolio yourself. The way that people like you and I, John, made money in multifamily and in rental housing, period, is by going in and value adding, by creating upgrades that people would love to pay for. That might mean what I call workforce luxury, which means going in and saying, I'm going to put in things that the three of us might expect to be in a apartment, period, at our grade. For something I'm going to live in, I have to have a dishwasher. I just do. I have to have central air. I have to have that. I have to have ceiling fans in my rooms. I have to have that. Certain people don't have that already. They don't even have washer dryers in their apartments. So we would go and add those things, as John would too, and all the other landlords did. Here's the problem now. You can still do those things, and a lot of apartments don't have those things now, but most Americans can't afford to pay the extra $200, $300, $400 a month that John and I need to charge for those things.
Pay back all that and to get the lift, yeah.
Yeah, you can't. So there's no
call it
more.
Forced appreciation.
I'll say it in one. I'll say what I just. I'm one to say, Josh. in like 30 minutes what could be said in 30 seconds. Okay. So I'll say it in 10 seconds. There is no juice left in the lemon. Period.
Hi, this is Melanie McCallan. Josh and I are just so grateful for the many investors who have already joined us at Accountable Equity. Accountable Equity is so much more than a capital group. It's really a community of accredited investors that want to learn and grow together. I just want to personally invite you, if you want to find out more about this type of investment and see if it's right for you and your family, please visit us at accountableequity.com.
Hey, it's Hal Elrod, author of The Miracle Morning, and you're listening to Capital Hacking. Enjoy.
Well, that isn't, you know what that sounds like? What do they call that? Clickbait. That's almost a clickbait, but
sure,
it's it's a little bit of an exaggeration, but I see your point. Let me say it the way I interpret what you said as a listener. 25%, if I was paying, like my wages haven't gone, meaning I'm the person staying in room 101.
25%.
Yeah, my wages did go up 25%.
Rent did, wages did not.
But rent did. So they call that the affordability problem, right? I mean, so the affordability measure and the index is you're overdoing it at that price point.
That's why you hear all these politicians running around talking about. I was scratching my head when you hear politicians saying, "We need more affordable housing in America. We need more housing." They took the word affordable out because it's kind of a buzzword, right? So they were just saying we need more housing. And yeah, I've heard like Grant Cardone's like, we need 5 to 6 million more units, or we need this more units, this more units. Here's what they really mean. They don't really mean that there's like, that there are a lot of homeless people in America, but they're not saying that we need all this housing to house the homeless. What they're saying is we need more housing because the supply and demand curve has gone so far one way that we need more supply, because what that's going to do is that's going to drop the price of housing, right? We need more affordable housing, cheaper housing solutions to start pulling the cost of housing down. That's why we need 5,000 to 6,000 more units into the market. All those things, I'm not saying multifamily is bad. I'm just saying that big value add, buying C-class multifamily, like old dilapidated 1970s, 1980s vintage assets, and doing big facelifts on them, that game's been fun. We've done it. It maybe is a game that still can be played, but it's not something that's going to be done as a mass effort for the foreseeable future that I think. Also factor in rates are high, and I am not one to believe that they're going to go down significantly anytime soon. We might see like a 50% basis point cut in rates, but I think rates are going to stay in the 5-6% range for the next 5 or more years.
Matt, I'll tell you, you have brought up so many great points here, and
bring it on, brother, fellow landlord.
Like, I'll go to the supermarket, and big thanks to my wife Christine, who usually does it, but sometimes I go and I don't think about it because she does the shopping and usually. But now sometimes I'll go and I'll not even have much in my cart, and it's $160. And I think to myself, I mean, thank God, we're in a good place financially, but I think to myself, man, if I worked like a 9 to 5 and had a salary, like I would really have to make cuts to make my life work, because everybody has to eat. I mean, that's essential, right? That's not something you can cut out. So you brought up some amazing points. And I also want to bring up to our listeners that if you're selling your multis, it's not like you're selling, you're just really trading, right? You're going into a different class with hotels. Could you tell us something about that and how you're going to make the transition? Can it 1031? What does it look like?
You want to try that again?
I think he's saying, are you doing 1031s when you sell these multifamilies, or are you, because they're in a captive fund, do you have to sell them?
We had a blip in the matrix there. I forgot. I didn't catch what you said for a second there. So you're asking, are we trading up? So I've got, here's what we're doing, right? I see the forest beyond the trees. I'll be open kimono, right? We've got assets, a few of them, that we're selling at not a full return of principal. I'm not going to let this thing continue to diminish. I got one asset I'm selling, and I'm going to be returning 80% of investor capital. First of all, there's no guarantee as a sponsor, right? There's nothing that says, hey, I use the G word and I'm going to guarantee you this rate of return on your money or whatever it is. But I'm not going to allow my investors to be in an asset class that I think is not going to do any better and may diminish over the next couple of years. So what we're doing is we are going to sell. And typically a 1031 exchange is something that's done when you've got a lot of gains that you want to preserve taxes on. But it can also be an efficient vehicle to move from here to here with very little fees, and allow your investors to kind of say, okay, put my money into that LLC, and the money in that LLC just rides up. So here's the thing. There are other things out there. You guys are familiar with the term equity multiple. You know what that means, right? So if I put $1 into a thing, an investment, I get $1.80 back in 5 years, right? That's a 1.8 equity multiple.
Yep.
So for every dollar you put in, you get the 1.0 is your money back. And then anything you get on top of that is profit. So you hear people talking about, John, I know you do a lot of passive investing too, like a 1.8 to 2.0 equity multiple over 5 years is a pretty good investment, right?
Mm-hmm. Yeah.
So we are seeing those returns left and right, not in C-class residential housing. I'm sure I could bake my numbers real good and cook my books or cook my financials to make it look that way, which others are doing, not us. But I'm looking at our numbers and saying, guys, there's no way I see a healthy investment growth. So what we're going to do is we're going to pull a plug. I'm going to sell. I'm going to take 80% of investor capital. I'm going to put it in this thing over here. That's on a 1.8 or one asset we're doing today is a 2.0 equity multiple. Take that 80% return of capital, put it into a 2.0. I walk out of closing 5 years from now with a 1.6 return on people's capital, right? They win, right? Warren Buffett, rule number 1, don't lose principal. And if I'm in a asset class where there is a high probability of principal diminishing, what the F am I doing? I am their custodian. So I need to get out of this. This isn't going to work. I didn't create it, but the storm I see the storm happening. So we are pulling out of a lot of those properties and 1031ing up into things that I do know that I do know that are going to work. And we're going to be walking out with 1.6, 1.8, 2.0 on the initial investment people made with us a couple of years ago. I'm not going to sit around and wait for the.
I I think this is real. This is real. This is a
talk,
real
brother.
conversation.
Real talk.
They just call it a deal deep dive kind of conversation. But let me make sure I'm a listener and I understood what you said. So I invested in a deal with you, let's say, and now you're offering me an option to roll that invested capital into a new deal or do I get my money back and choose to buy your next deal? Which way is it?
You can get your money back. We're doing it through a 1031 because it's more efficient that way.
Okay.
I could sell, give everybody a check and say, okay, here's now that check has cleared, would you like to put it back in this new thing? We're not doing it that way per se. We're doing it like, hey, here's a 1031. It's going to roll up. And if they say, no, I don't want to participate, great. Here's your money back. You can 1031, getting a little complex, but I can talk you through how it goes down.
Well, actually, you're the first ever who's ever talked about this in all my years of listening to podcasts. Sure. So would you teach us this? This is just education. Yeah. This has nothing to do with Matt Faircloth.
Here's how it goes.
How do you do things?
You got asset A, right? And I'm going to forget about the principal value or whatever. I've got asset A and I'm going to 1031. And this is a syndicated asset that I've got 100 investors in for round numbers, right? $10 million. Again, I'm going to keep using round numbers so we can chop it up. I'm going to take that asset. I'm going to sell it. I'm going to take all that principal and the GP profits. If there is GP side profits, so that means the person that put the deal together, I get my slice. All that needs to get rolled up. Nobody takes a nickel out of the deal, right? All that rolls up into the next thing. That's asset B, right?
Okay.
Whatever it is. Any sticks and brick real estate qualifies for a 1031 exchange. All the money has to roll up. Then you have the conversation. Well, actually, while you're rolling up, you have a conversation with investors and say, okay, who wants in, who wants out? So maybe if the good Lord blessed you and you put 100K in and you're walking into the new deal with 150K in profit and 50K in profit, 100 of your principal, then you could say, I'd like to keep my 150 in that new deal as a new cost, as a new basis, as a new investment. Great. Investor B says, you know what, Matt? I'd like to take my 150 out, right? And a few people say I want out, a few people say I want in. And of the 10 million that you rolled over, 3 million of it wants out in aggregate total of investors. 7 million of it is agreeing to stay. Whether that is a profitable transfer or a not a profitable transfer doesn't matter. All that matters is you have these $3 million of people that have said they want their money back. And as a syndication, you can't force them in. If there's a change of asset, you got to give them an out. So what you do is you got to go and pass a hat around and go raise new investors, right? And the new investors need to come in at new fresh capital at today's number. Now they're coming in at what the value and the return profile looks like on asset B. It matters not what asset A's performance was. That's not their concern. Those that got on into asset A, God bless them, they're rolling up whatever profit or whatever they got or principal into asset B, and then they start. And then new investors come in, and now they're equal dollar for dollar in asset B, and everybody moves forward. So for the $3 million of people that want out, all that happens is you have to go raise that $3 million from new people, and that those dollars get reallocated and everything like that. Those people get a check. It'd be like John buys shares of Microsoft one day, and I buy those shares on a public trading platform from him at whatever they're worth on day two. It's in essence, somebody come in and buying that person's shares at whatever their value is at the time that they're buying in. So that's how a 1031 goes. And what's beautiful about it is it is an exit point, a true exit for investors. That they can choose to get off the train or choose to get back on for another ride if they'd like to.
That's awesome.
Yeah.
No, and have you finished the first one of those, or is it's on a timeline right now?
We're in the middle of a few of them. I've got one where somebody put in $1, they're getting $2.50 back out.
Okay. That's a lot of money.
I have a 2.5 equity multiple. God bless everybody. God bless us. We're going to make a nice little check on that one. And I get the rights, Josh, as a syndicator. For those of your listeners that are syndicating, if you're able to pull things together the right way, when you sell, why not roll it up through a 1031?
Right.
I know it's tempting to pull all your profit down, but then what I can do is I can roll my profit up into the new thing as a passive investment. That becomes an LP share that I get into the new thing.
Wow.
And I get an acquisition fee. I get a new carve out, a new percentage of profit that if I could achieve over metrics, money that I get to in the new asset. So I get to play the game all over again in a new 1031. So that's what's beautiful about it across the board. It's a win for investors because it's tax deferred or just an efficient way to transfer capital up. So,
no, it's really, really exciting. And did you look at sorry, John, did you look at the roll up? No, I guess you wanted to exit some assets, so you can't do a REIT in this scenario.
No, you wouldn't do that.
You wouldn't do a roll-up REIT.
You don't want to do a REIT.
John, go ahead.
I forbid anyone listening for ever doing a roll-up REIT. Don't do it.
So
you got to teach us why.
The only thing I was going to add, and I haven't done it in the way that you have because I don't syndicate, but I've done I think 4 1031s at this point. I'm about to get into another one.
Nice.
You have to, if you're selling, let's say if you sell, the product A for 10 million. Product B has to be 10 million or more, correct?
$1.
Yeah. It has to be as much. If it has to be a little bit more, you can't downgrade. You have to upgrade in 1031.
Well, you can pour all your money into it. What's that?
You could buy 2 things that equal 10
correct.
million, right?
They have to add up to more than the 10 million, and all the money that you make from selling asset A, every nickel and dime needs to get rolled into asset B. People get fancy pants too, John, where they'll buy something for a little bit more than they sold asset A for. Buy it mostly free and clear, or put a little bit of short-term bridge debt on there, and then let it season for a couple months, and then they'll refinance it.
Yep.
Again, if you can find that exact equation, that's kind of a unicorn, but go for it if you want to do that. That's a way to to strip your equity back out if you want.
Smart. It's awesome. So tell us more about the hotel stuff that you're getting yourself into.
Yeah, man. Well, hotels are. I mean, here's the problem that. Here's what we're in the middle of as a company is educating our investor base on why there's other places to make money aside from multifamily. Multifamily is great. It's not something we're abandoning. We're still making bids on multifamily, just not the C-class stuff that's gotten bid up. I mean, C-class real estate, workforce housing has tripled in value in the last 10 years.
Oh yeah.
It has not tripled in revenue. It has not tripled in a lot of different things. It is probably degraded and become worth less physically because of the amount of work that it needs. But it's gotten bid so much because it's such an easy playground. It's such an easy value add place. As I said before, I'll just drop in a dishwasher and I'll drop in a washer dryer, and working class Americans will gladly pay me $300-400 a month more to live there. The problem is that, like I said, the lemon's been squeezed. So now it's my job as a fiduciary to go find the next playground, right? And so that could be newer build multifamily, because that's something we're looking at too, like multifamily that was built in the last 10 years. A lot of developers built multifamily thinking that things would continue to hockey stick up. They didn't. And so now they're, selling a lot more reasonably. That's a little tip to your listeners. If you guys want to stick in multifamily, great. Up your asset class that you're shopping, and you might be pleasantly surprised that the numbers actually work the newer the property is.
Oh.
So that's what we found too, so we're bidding stuff that was built in 2015, believe it or not, and the numbers work. Okay. Anyway, what we're liking about hotels is there is a cap rate, right? People think, cap rate, all that is like a profit, like how much profit you can make on a deal. All cap rate is like the NOI on a property as compared to the purchase price. Right. So people think it's a rate of return, right? You guys know what cap rate really is? Take a guess, Josh.
So the irony of cap rates for me is technically if you own stuff in cash, you'd want, or if you bought it yourself, you'd want a higher cap rate because you'd make more money on what you put in.
Yeah.
But over the years, we've been taught by low interest rates that we all want lower cap rates because it jacks up your ability to borrow. And when borrowing was free, of course you wanted to borrow as much as you could. When borrowing is extremely expensive.
Yeah.
Higher cap rate and making more money per dollar seems good to me. So anyway, how do you describe it?
Here, this is like you guys probably know, I met him through Bigger Pockets, but Brian Burke. He's an he's a sage. It's just
he is a sage
being. And if you guys haven't had him on the show, you should.
We have. We should do it again.
Yeah. He blew my mind one day. So I'm speaking in a room and he was giving this lecture about cap rate. He's like, how many of you guys think cap rate means a return on your money? Or like a way to govern profit? It's like, no. Cap rate is risk factor, right? That's what it is. Because let me put it this way. If you got John investing, right? And John says, you know what? I want to keep my money at low risk. I will go put my money in a savings account and I'll make 3%. That's his return on investment is 3%. If Josh is like, I want to go and play crypto, or I want to go and get to something that's perceived to be higher risk, he should be expected to make a higher return on his money. Cap rate kind of correlates the same way. It's expected that you should be making a better return on your money the more perceived risk, and I underline that word perceived risk that you're taking. So hotels, guys, trade at a higher cap rate because there is a higher perceived risk in the market of a hotel, period. And so because a hotel trades a little bit higher, that means in cap rate, and I'm talking like a multifamily might sell at a 6 or 7% cap rate on the really high, maybe probably 5 or 6. And back in the day, John, you and I were looking at deals that are like 4% cap rate. And it's like, geez, I'm going to make these numbers work. Who cares? That's just what it's selling for. But hotels are trading at sometimes 9 and a 10% cap rate because of the perceived risk the market has for a hotel. And so what we figured out is, okay, let's get into the hotel world because the cap rates are much higher. And if I can borrow money at 6.5, and buy a property performing at a 9 cap, I make all that yield spread, the difference between those two things, all translates into cash flow, right? And that means that if you find the right hotel deal, it is a great cash flowing asset, which is different than multifamily, which sells at a way lower cap rate, right? It sells at a 5-6% cap rate, which is, you can make money at a 5% cap rate, but the way you got to do it, you're not going to make any cash flow during the whole cycle. But what's going to happen is you squeeze the lemon, I increase my bottom line and run a good business and put in dishwashers and washer dryers and all those things. And that makes a property that was bottom lining at $50K a year, I bottom line it at $100K a year, right? I was like, oh, that's only $50,000 in profit. No, on a 5% cap rate, I just double the value of that property, right? Mm-hmm. It's worth a ton more on the math, right? So multifamily at a lower percent cap rate is a value add play, right? It is something that
that's right.
You make your money through appreciation. Yep. And you can make a lot of money in appreciation for all the reasons. But the reason why, it's because America needs more housing. No, it's because it trades at a low cap rate. That's it.
That's right.
Because the algebra you got to do on what it's worth is based on a low percent cap rate. Hotels trade at a much higher cap rate, so you make your money in cash flow. You don't make your money on appreciation. So we're under contract in 2 hotels right now, and 80% of the profit is going to come through cash flow.
That's
20% comes through appreciation, where you might look at a multifamily deal, and Josh will be the other way around. You might make a little trickle of cash flow, and then you make an absolute tsunami torrent when you sell, right? There's a multifamily I'm selling right now in Lancaster, Pennsylvania. I bought it for $3.35 million. I'm selling it for $8 million.
Wow.
And that's reasonable
awesome.
in multifamily.
Lancaster's
right?
come a long way. That's fantastic.
Yeah. God bless. Right. A lot of GoBros involved in that one, by the way, John.
Oh, cool.
So now on the other side of the coin, we're buying a hotel in Milwaukee and one in Houston. Both of those are buying for around $10 million a piece, right? My underwriting says we're going to sell them for 11.5 5 years from now. Not a bad deal. That's pretty good appreciation. That's not good appreciation, but it's great cash flow. They still return over 20% cash on cash to investors because of cash flow. Robert Kiyosaki 101. He didn't talk about appreciation. He talked about cash flow, right? That's something that I can control much easier. So that's why I love hotels, certain hotels, not the bougie hotels you see people taking selfies of, the boutique hotels. Like, hey, I just turned this roadside motel into this cool Airbnb thing or whatever. No. That's not something that's a business that if I can't do it 1,000 times over and over again, I'm not doing it. If I can't repeat it, we're not doing it. So, and it's not spots like you have, Josh, where you're creating a experience through what you've got. If you don't mind me saying, touting you a little bit there, right? It's experiences. That experience could be an incredible round of golf, a great dinner, a wedding, a business retreat, a whatever. These are resort retreats. That, my friend, is not what I'm buying because I am not the Walt Disney of resorts. I can't do that like you can. So that ain't what I'm doing. What we're buying are things that Americans need on a regular basis and things that a lot of people use. Right. And so these are usable hotels that people on their way from A to B stay in. These are Hilton branded assets. 200 million people are part of the Hilton Honors system. So that's what we're buying, is because it's a recognized brand and they do 80% of the work. We do the other 20, and that's what we like. That's what we like.
No, I think you did a really nice explanation of the whole vision there, and cash flow and higher cap rates not being a negative.
It's a good thing.
Yeah, most people didn't see it that way for the last 6, 7, 10 years, right? I mean, lower the cap rate, compress cap rate. Now,
Hey guys, it's John Vroman, founder of Front Row Dads, and you're listening to Capital Hacking, the best investment you'll make today.
Let's talk a little bit about the brokers. You know, you had spent a generation here getting to know brokers. I imagine that's how you found all your multifamily deals over the years. How did you switch the universe of people you were speaking to find new types of deals? Like, how did that come about?
Well, the brokers, we do a lot of like, and for the listeners, you gotta go full spectrum. We believe in choosing a market first and then getting to know everybody in that market, right? In multifamily, the market centric investing is the only way you can make it work, I think. And so we would pick, Winston-Salem, North Carolina, where we own a couple properties, Lexington, Kentucky, where we own a good amount of properties. And we get to know everybody. We got to know everybody in that sandbox. And, the one shingle guy where like it's Joe Smith and it's called Smith Real Estate, right?
Yep.
We got to know that guy. And we also got to know the big fish like Marcus and Millichap, Cushman and Wakefield, those guys. So that's the way multifamily investing works through broker relations. Hotel investing is a whole different game, man. Most people that sell and buy hotels are doing it through brokers that specialize in that. And so we had to transition and go to the Cushman and Wakefields, Marcus and Millichaps, the Northmarks, the big fish of the world, and say, I want to talk to your hospitality division. And they would say, great, we're your multifamily guy. Let me introduce you to other, because a lot of brokers have agents that specialize in different asset classes.
That's right.
And hotels tend to be a wider geographic territory, but very buyer and asset class specific. So that's
and the way they trade is sometimes they trade in groups of properties, get 100%. Distributed by a REIT or something. So who are the sellers of the two properties? Are they like a REIT that's selling these buildings off?
REITs and Indian guys.
So the two, are they from the same seller?
Fact. With it's normally not same. It's not the same thing, but we've bid deals on REITs. We missed by 2 inches. I'm pissed on this one. On the hotel that was owned by the REIT by a REIT. It was attached to the Mall of America, Josh. Can you believe that? You want to talk about an experience? That's the mall that's got a roller coaster inside it. I believe it still touts the moniker of being the largest mall in the world. They probably built something in Dubai bigger than that now, but but anyway, it was for a while. It's probably the largest mall in America, and this hotel was attached to the Mall of America, owned by a REIT. They were lucky enough to buy it for $24 million, and they ran such a great business plan that they were selling it for 12.
Wow.
Because this is how REITs roll, man. They can, we'll make money over here and we'll wash our hands over here, right? So they were selling it for 12, and we got outbid. This is one of those close that just pisses you off. It's like, couldn't we just figure it out? We got outbid by like 1.5%.
Wow.
By like literally a couple $100K. And I'm like, couldn't I just cut my fee a little bit, or couldn't we have but the broker didn't tell us. So typically there are REITs out there that got themselves into the wrong thing and are looking to exit. A lot of hotels, Josh, get sold on 10X commercial. You guys familiar with that?
Yeah.
Isn't that Crexy?
It's like 10X Commercial is owned by LoopNet, which owns.
Yeah.
So I think CoStar is the parent company. So CoStar owns Apartments.com. They own LoopNet, and they also own this auction site called 10X Commercial. So a lot of hotels, Josh, get auctioned off.
Right.
Yeah.
Because they get dumped at big
a whole new way. What's that? Sorry.
There is another, briefly, it was introduced to me at one point, this intermediary that had 100, REITs have to dump certain number of properties every few years or whatever because of and this guy was like, I think he had 15 or 20 hotels he had to sell, or had them in a bundle. He's like, we're going to buy the bundle, then we're going to fraction them off and sell them one by one. And I thought to myself, that's how this works. Okay. And I've never really dug into that.
Gere from Pretty Woman. Remember him? You guys are old enough to see that. That's what he did.
Marcus Milchap is a big, well, no, they're mostly multifamily. Yeah. But if anything, they'll sell the select service.
They'll sell you a car if you let them do it, man. They'll sell you those guys sell all kinds of stuff. They sell industrial. They don't really tout it because multifamily's been the darling over the years. But these guys, all those big firms have hospitality divisions. And so what we had to do over the last year is to get to be friendly with those guys. We also hired an underwriter that he underwrote this is how it all went down. We hired a guy that works for DeRosa last 2 years, phenomenal human being. And he underwrites all of our multifamily assets, but he came from the hotel world. And so he's been educating me and my partners on hotels and how they work and showing us the profit and loss. And I'm like, wait. You're walking out of closing making 9% cash on cash day one with a hotel deal? I'm like, seriously? And he's like, yeah. Here's the numbers. Does that works? But you got to buy, flagged assets, not like boutique roadside, motels and stuff like that. You got to buy, nice assets that are, that have a flag on them, like Hilton, Marriott, IHG. That's right? Fair enough. So we got educated on that world and we started to chase it. And he knew a lot of the folks he used to deal with when he was in the hotel space. So he kind of brought them into the fold. We had a lot of conference calls with him and started raising our hand on a few deals, swung and missed a lot. And we finally connected on 2.
That's awesome. Congratulations.
Yeah. Thank you.
And how can people reach back out to you? Because I know a lot of people are going to be curious after this. Not only do they need to buy your book and listen to your shows on Fridays.
You can do that too.
But how else can they reach out to you, buddy?
All the things. They can go to DeRosaGroup.com, DEROSA, DeRosaGroup.com. They can look at all the different investments we have. Yeah, you want to get involved in a branded hotel with $1 billion company standing behind us? You can. You want to learn about multifamily? You can. You want to be a multifamily operator like me and John Edwin are? There's an education program called Accelerator there you can check out too. So you can learn to do what we do, or you can join us alongside as an investor at DeRosaGroup.com.
I love it. Checking it out right now. Thank you so much for being here, buddy.
Matt, you're the best.
You're the best.
Damn straight. We just got
buddy.
We got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love it. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.